Welcome to Bullshift, the podcast, where for the next 30 minutes or so, we'll be talking about behavioral biases in the financial services industry. We'll be talking about how the people in the industry shift your attention to being more bullish. I'm John DeGuy, the author of Bullshift, the book, and the host. My guest this week is Larry Berman, and it's a wonderful thing to have Larry on. I've known Larry for some time, where we've been acquainted for many years. He's the Chief Investment Officer at Q Wealth Partners, and since 2007, he's been the host of Berman's Call on BNM Bloomberg. He's got extensive qualifications and experience. He's been in the business for over 30 years as a person in finance. He's a chartered market technician, a chartered financial analyst, and a registered commodity trading advisor. So a wealth of knowledge. Larry's got a BA in economics from York University, and it's a pleasure having you on the show today.
Well, thanks for the invite. When you're talking about behavioral influences on markets is close to my heart because it's something that I focused on for a long time as well.
Okay. So let's begin with something just sort of as a good sort of bit of groundbreaker. A lot of people have biases. We all have them. And maybe you could tell people that are listening and watching about the differences between cognitive biases and processing biases and emotional biases, because it's important to understand the different types.
Well, absolutely. So the cognitive biases are pretty simple. They're up here on this side versus the emotional side, if I got that right. There's left brain and right brain. And there's a tremendous amount of academic work that's been out, probably started in the 1960s and 70s. One of the books that's been very influential for me is the work of Daniel Kahneman and Amos Tversky. And it goes back to the 1960s and 70s, where they first started talking about, if I can put it this way, the silly decisions people make, right, in the moment. And some of those decisions, John, are emotional. There's risk. Your money's at risk. You're seeing red on the screen in terms of your portfolios, and those tend to be from the emotional side of your brain, where the cognitive choices that we make, where we think we're being rational, comes to things like, mental accounting. I'll give you an example of mental accounting. So I bought a stock here and it's now here, but if it gets back to here, I want to break even and I'll get out. Mm-hmm. So that's a cognitive, thought process. And so you think you're making a rational decision, but the thing is, the market really doesn't care where you bought your junk, if I can use that terminology. So, I gave a lecture at McMaster years ago. I was actually one of the first people in Canada to, if not the first, to have both a CMT, Chartered Market Technician, and a CFA, Certified Financial Analyst, Chartered Financial Analyst. And the combination of looking at the rational expectations, the fundamentals, if you will, and the behavioral side or the emotional side, or what we look at charts for often to get a interpretation of what's happening, kind of under the surface. And I'm giving this presentation, and there's a professor standing there in the corner, and he's shaking his head. No, like this stuff's nonsense. You're looking at charts and behavior. And I said, Professor, what was the last stock you bought? And he said, I bought Air Canada. And I thought, okay, well, he probably bought it around when it was issued. And so what did you pay for it? He goes, well, $10. I said, well, what is it trading at now? And I knew it was 7 and change, right? And he says, I don't know, it's lower. I said, yeah, I think it's probably about 7 something. So what would you do if I told you that it was likely going to rally to 10 in the next 6 months? He goes, I'd probably sell it and get my money back. I said, you just proved my point. So there's a lot of these things that we think about that are cognitive. They're very much behavioral. A lot of them are emotional. And so they're all interrelated because they all come from, what's up here. And then there's the nudge effect, where if you look at some of that behavioral research, I can set up a research report, for example, and I can present this argument, which is my probable scenario, this argument, which is my less probable scenario, and kind of guide you to where I want you to be in your decision making. And there's a whole host of research around, kind of driving.
Yeah, what Richard Taylor would call choice architecture, him and Cass Sunstein with the book.
So there's all kinds of stuff that is part of the everyday,
right,
that we think we're making rational decisions on, and we end up being at risk to some of these cognitive and behavioral biases.
Right. Well, it's funny that you mentioned Daniel Kahneman, because he's one of the first as well. And I read Thinking Fast and Slow. I got a chance to hear him when he spoke at U of T when the book came out, whatever that was, 13, 14 years ago. And he's still around. I think he's probably about 90 by now. But what a great mind. And the work that he did with Amos Tversky back in the day, it's really remarkable. I don't know if people have also read Michael Lewis's book, The Undoing Project, but it's a separate sort of book about the friendship between the two of them, the way things sort of came about. It's fascinating how a lot of people just don't meta-think. They don't think about thinking. And that is an important sort of skill to have when you're making decisions in life in general, but in investing in particular, because it's the sort of thing where we might let these cognitive biases get in the way, and we ought to know better, but we do it anyway because it just feels good, or because it's just the way our emotions are driving our decisions. I'm wondering if you could maybe help us, Larry, by talking a bit more about the problem of overconfidence. So the book Bullshift talks about optimism bias, but overconfidence and optimism bias are very, very similar. But I'm wondering if you could maybe talk about how people are overconfident in general and what it means for investing in particular.
So pound HODL is the, the hold that was typo or it was spelled. It's people's underlying belief about, a worldview, a market view, whatever it happens to be. And you think you're so confident in that view that you can't possibly be wrong about it. And when it comes to investing, I think what you have to learn, and 35 years now of getting beaten up by markets that is the best teacher, is that you need to be humble. And so when you're so overconfident in what you believe, the market is a humble, Mr. Market is a humbling teacher. And you'll go through these periods, and we're going through one now, John, where, if you were a growth investor, we had a whole new generation of investors born after COVID. Mm-hmm. Government gave everyone a bunch of money, and all of a sudden you're out of work and you're day trading from home. And the Reddit communities and the meme stocks, and come on, GameStop is not worth anywhere near that. And neither is AMC or any of these absolutely moronic, idiotic narratives, if you will. But people had so much confidence in the belief, and that it's hard to change. And so being able to admit you're wrong is a part of it, but it speaks to discipline in style. If you're a momentum investor, there's nothing wrong with trading GameStop, as long as you recognize when the momentum changes that you should probably not be in the position. And so when you're overconfident, you go, no, I'm right. It doesn't matter. The market's wrong. I'm right. And you pound your fist, and all of a sudden you're holding Bitcoin, buying it at 40,000 when it's at 16, or whatever the flavor is of the day.
People are notoriously overconfident in all walks of life. I think there are dozens of studies that show that something like 75 or 80% of the population think they're an above average driver. And and people think they're an above average lover and above average everything like that. Everyone sort of says, well, whatever the by definition, I think George Carlin has a line. Think about how stupid the average person is, and then just realize that half the people are even stupider than that. And it's funny because we have a hard time calibrating where we fit relative to everyone else on the spectrum and all manner of decision making. I'm wondering if you could maybe talk a little bit about the Dunning-Kruger effect. I think you're familiar with it. Which is work that was done by a couple guys at Cornell about 25 or 30 years ago, where they showed that, what's the old saying, you don't know what you don't know because you don't know what you don't know. So there's a lot of sort of people who think they're good at things and they're unwittingly incompetent, but they don't recognize their own incompetence. I'm wondering if you could maybe say a little bit about that. If I think you know a bit about it. So
when you talk about confidence,
yeah,
I'm a CFA,
right.
I'm a CMT, I'm a registered commodity trading advisor. It doesn't make me good at it, right? It makes me certified. It means I've passed some exams, and so I have the ability. But the being an expert at something. If you've read, what's his name? His name's escaping me right now, but he talks about repetition and practice.
Malcolm Gladwell with a
Malcolm Gladwell outlier, right? And so to become the Beatles, you have to have that certain expertise. And a lot of people, here's a great example. I broke my wrist a decade ago. I was in the emergency room. I had my x-rays done. Doctor comes over, and I think he's got his laptop, not a laptop, but his tablet. And I think he's going to show me the x-rays. Here's where it's broken. He brings out his portfolio, and I'll start asking me questions about his portfolio. And I said, Doctor, do I go into your operating room and tell you what, and it was kind of that, where you don't know on the Twitter sphere how much of an expert someone is. People hold themselves out to be experts, and just given, even if you have some experience, it doesn't make you good at what you do. You might be a very good salesman, for example, right, but you're not necessarily a great practitioner. And it goes back to what I was saying about understanding and being humble, right, when you approach markets or a lot of things in life for that matter, and learning humility, and that the Mr. Market, the greater, has much more influence than you think, right? And what's that saying? The market can be rational far longer than you can remain solvent.
Irrational, yeah,
right?
yeah.
So fighting the market because you're confident, or or you think you have some expertise, you can't be right all the time. I did a very interesting study on my own work. So in the decade that I was a strategist for CIBC World Markets, and the years before that where I was doing research and trading, I went back and I looked at all the written research reports I had done. And I looked at when I was right or when I was wrong. And I was right pretty good, about 65% of the time. So, 2 out of 3, pretty good, 60%. But I was wrong a lot, right? And the thing is about that analysis, you don't know ahead of time when you're making that next call if you're going to be right or wrong. And so, again, it speaks to having a process, understanding what your goal is, and that actually increases your expertise, yeah, and your ability.
And your humility, too, because, as you go through, I've been around the block a few times, too, and it's the sort of thing where you have to be careful to be not too definitive, because none of us really knows for sure. All we're getting is educated guesses about what's going on. I'm wondering if you could maybe talk a little bit more about optimism in particular. And most people think of optimism as being a good thing. Kahneman, for instance, has said, if he could endow children or grandchildren with one thing in life, it would be optimism and joy, because it has so many positive aspects. And I think there are a lot of positive aspects to investing too, but Maybe if we could you maybe offer your thoughts on what could possibly go wrong as a result of being optimistic?
Well, so I get accused of being a bear.
Uh-huh.
People call me Berman, not Berman sometimes, and I take it for what it is. But my process is I look at the risk element of the investment first, where if you're super optimistic in general, you're only looking at the return without looking at the risk. And so there's this thing called a Sharpe ratio, and that is what's your return, and Nobel Prize was given for this, by the way.
Well, sure, yeah.
What's your return relative to your risk? And I concentrate on the risk, because if I'm wrong, never mind if I'm, when I'm wrong, because I know I will be wrong, how do I manage around that? And I think while it's good to see the glass as half full, it's the other half too, like it's a two-sided equation. And so risk and return go hand in hand. And if you're too optimistic and don't worry, that's fine. If your mental capacity doesn't subscribe to Kahneman's risk aversion theory, meaning we like our gains, but we hate our losses a lot more than we like our gains.
2-to-1
so
ratio.
we have this skew between periods where it's not working out,
Right.
and periods. And so hope is not an investment strategy.
Right.
Hope for lots of things in life is great. Having faith is wonderful. It's a gift that I've never received, frankly, but having faith, it's great. But making that your strategy and having your retirement future based on that is just a bad idea.
What do you think about people who give financial advice to retail investors? Do you think they're too optimistic, or do you think they're properly calibrated?
Well, it depends. I'm a matter of fact person. If you go back and look at 100 years of data, 60-40 portfolio, 7-8%. That's your number. But 2 years ago, John, when interest rates were zero and valuation of equities were, I'm off the screen here because you can't see it. There was no chance that a 60-40 portfolio was going to deliver in the next couple of years anywhere near that number. So that's the concept of standard deviation. And again, it's the risk part of the component that the street doesn't talk about. The financial planner is saying, yeah, we'll get you 8 or 9, or we'll get you 7, or whatever that number is, right? When you're talking to a person, there's nothing wrong with saying 7 or 8. But what you should be saying is, well, that's the long run number, but maybe the next few years are going to be 3 or 4. That's a terrible sales technique, by the way, because the sale is going to go to the one who gives you the optimistic outlook, right? Not the realistic one.
That's exactly what I talk about in the book, is that the industry is rooted towards sales. And what you've touched on, you didn't use the actual phrase, but it's the cyclically adjusted price earnings ratio that Robert Shiller came out with, which he also won a Nobel Prize for. And Shiller's written a number of books. I've had a chance to meet him as well. And that's exactly one of the things that I lament about, is that if you're doing a financial plan and your number is 7 or 8, but if 7 or 8 is based on historical valuations where the CAPE is in the teens, and now the CAPE is in the mid-30s, which is where it was at the end of 2021, there's a lot of evidence that shows that cyclically adjusted price earnings is a lousy way to time markets. It doesn't work, but it's very reliable in giving you a sense of what the next decade is going to look like. And here's the news: when CAPE is way high, the expected returns is really low, and that's just natural reversion to the mean.
I was at an ETF conference in Florida. I don't know, maybe it was a decade ago. It's a big one they do in the winter there, and it's an easy one to go to because it's Florida in the winter. But there's great speakers, and so I'm in the gym in the morning before the conference working out, and I'm on the elliptical like this, and I'm looking at the next one next to me, and there's a guy reading the Economist magazine, and I look. It was Bob Shiller. And so I chatted him up about a couple things, but we specifically talked about the CAPE at the time, because that's a pretty interesting guideline. But it could be at 30 for 3 years before the markets actually have an impact. So as you point out, as a timing mechanism, there's no one thing. I get asked all the time, what's the indicator? And it's like, listen, if I figure that out, I'm not.
Yeah, exactly. It's like picking lottery numbers. The last thing you want to do if you figure out how to pick lottery numbers is to write a book about how to pick lottery numbers. You keep that information for yourself and win all the lotteries. That's what you do.
It is. And so I think when you go into this field of behavioral and you do all the studying, and what you realize is the investing world's a bit about probabilities. And when the odds are unfavorable, you should probably dumb down the risk a little bit, whatever that means for you as an individual. So if on average you're a 60-40 kind of risk tolerance and the outlook, it doesn't look favorable for the next year, maybe you go to 50-50 or 40-60.
Right.
Now, that's not timing the market. That's being prudent. What timing the market is, the CAPE is at 30, I'm going to cash.
Yeah.
If cash is at 0 and paying nothing, then that doesn't meet your need either. And 3 years from now, you might be right, or it could be next week. And that's the part about timing markets that's very difficult. So, they say it's time in the markets, not timing the markets. And I believe that, but I also preach being active and trying to make decisions cognitively, emotionally, behaviorally, when the probabilities are, pointing you in that direction. And I think if you take that lens and take everything in the behavioral sphere, including understanding how the street presents things probably way too positively, like you're never going to see the Federal Reserve say we're forecasting a recession. Like they're just not good.
But they will say pain is coming, right? So you're right. So yeah, so it's about as close as you can get. I'm wondering if you can maybe offer some thoughts to the people that are listening in about what they can do to do a better job of self-regulation. What could they do to be more reflective, to think about themselves, to say, oh, geez, I didn't think of myself as making these emotional decisions, but I listened to DeGuy and Berman talk, and I realized that, what's the old joke? Now that I look back on it, I find myself committing hindsight bias all the time, right? So you do these things.
My investment style, for example, I have this 80-20 philosophy. It's part of the Pareto principle, but 80% of what we do really well. And then you go through an experience, markets, whatever, life experience, and then you say, well, what did we do well and what could we have done better? And when you think about it from that standpoint, you'd say, okay, I should have went all to cash or whatever. I'll give you an example. So about a decade ago, we were going through the first part of the Greek crisis, where they shouldn't have been in the EU, but they were having all kinds of debt issues and there was a lot of volatility. We had just come out of the great financial crisis. And now Europe was going through their version of it with debt and everything. And I had said, because of what I saw in the charts, I thought the markets were going to have a 5 or 10% correction. Okay, so I say that weekly, like, something's going to happen. Well, it turns out the markets have a 5 or 10% correction pretty much every year. It's normal, actually. It's not. So someone was watching the show, and I ended up sitting next to this gentleman on an airplane going to Calgary, and he chirped my ear off for 4 hours and saying, Larry, you told me to sell. I said, sir, I've never met you. What do you mean I told you to sell? He said, well, you said there was going to be a 5 to 10% correction. I said, but if you did your homework and knew it and understood it, that's normal. And in fact, when that happens on average, you should be buying, not selling. And so you were trying to time the market and be cute. And I wasn't being flippant with him, but I was in a way, because I was trying to make a point. And so, getting back to your question, and sometimes I answer very elongated, because when I'm on TV, I got 10 seconds to answer a question. And I know you do the same on BNN. Right. So you got to be quick, but understanding that you're going to get it wrong a lot, and have a process that when it's wrong, it's not catastrophic, so that you can recover. And then the next time you make a better decision about it. Right. Because we can only make a decision. The chart ends here. Hindsight, you want to see what's on this side. Oh, I should have sold. But we don't have that benefit. We have to make the decision based on what we see today. And we want to make a cognitive decision. We want it to be less emotional. But the more cognitive and less emotional, the more fact-based it should be.
Right.
And so probability. And so if the CAPE is here and bond yields are here, it's probably not going to be a good year for the 60-40, but who knows? And it turns out it's the worst year like pretty much ever. And so we'll see how that goes. But to me, that was a no-brainer. But I gave it like a 90% probability. Why? Because you just can't be overconfident to the point where, what if yields go negative? Well, it probably wasn't going to happen in North America, given how money markets work here. But it happened in Japan and it happened in Europe. And they have a very different system there for money markets. And so it was more viable in those markets than it would be in North America.
All right, so as we head into 2023, I'm wondering, there are a lot of competing narratives about what people might be expecting, and I don't really want a prediction, I don't want a forecast. I'm wondering if you can maybe just sort of have the people that are tuning in sort of help them to sort of zone in on those things that they should be focusing on. What would you tell people to focus on and pay attention to as we sort of have things that are going to be on our radar throughout all of calendar 2023?
You know, your portfolio should reflect your long-term goals for whatever they are, and say, so your RSP should be structured and geared towards, I'm not going to need that money till I'm 65. So if you're 35, you've got a very long-term horizon. But if your behavioral effect is that you can't handle the volatility, then you got the wrong portfolio. I saw an interview with Harry Markowitz, and he's the guy who created the efficient frontier and again, Nobel Prize winner. And he said, I created all this stuff, but I don't like seeing my portfolio go down, right? And that's the emotional response. And so I think there's going to be a lot more emotional responses to come. It's going to be far harder for the central banks of the world and the governments to stimulate, given the underlying inflation that's building. So inflation is going to be a big part of the narrative for the next years. I think the less globalization, it's more inflationary. So I think we're at a point where we're exhibiting some dynamics globally where the tailwinds of the last decades are changing. And I'm not trying to say it's going to be bearish necessarily, because there's some very bullish scenarios you could paint if inflation comes down. And so that's going to be the big thing for 2023. It's easy to go from 9 to 5. It's going to be a lot harder to see that core inflation go from 5 to the Fed's target of 2. So if I'm going to make any forecast, I think the Fed, probably around the Jackson Hole conference next year in August, is going to officially raise that bar for inflation from 2 to 3. Because if they're waiting for it to get to 2 before they can provide some stimulus, they might have a challenge with that. And so there's a lot of economic theory that's been disregarded. I don't think that's a word. But it's been pushed aside because we've had this tailwind of globalization, falling inflation and interest rates for decades. And I think it's just going to be a little bit more sticky. And that has a meaningful impact for asset markets, both bonds and stocks. And I think, and I kind of hate to say this because I started a company called ETF Capital Management on a BNN. I'm the ETF guy that people call and ask ETF questions every week. But I think active management starts to do a little bit better than passive. And I love ETFs still for a lot of the benefits that they offer. But I think being active is going to actually, for a little while, make a little bit of a difference. So those are a couple of things there that I would suggest people think about.
Great. Okay. All right. So we're running out of time. I wanted to, the podcast always ends with my favorite segments, which is, the first is That's Bullshift, and the second is Shift Happens. So That's Bullshift is where I invite my guests to say, there's something that's sort of sticking in their craw that they're not happy with regard to the financial services industry. If possible, maybe talk about the optimism bias of the industry, because that's how we're shifting things to being bullish. But maybe it's something else. I'm wondering, what if there's one thing that really bothers you about the way the financial services industry works these days, what would it be?
Well, I'll tell you, it's the lack of honesty, and not that people are dishonest, and don't get me wrong there, but the street paints a positive bias because you're in the business of selling financial products. And if you asked the economist at a bank X, okay, what his unofficial view is, it's a different thing. And it reminds me of Henry Blodgett. And there's a very famous story out here with the tech bubble in the late 1990s, where he was the analyst who was pumping these stocks and telling the story and writing these research reports. Meanwhile, on the other side, he was calling his best clients and said, yeah, like, I'm going to put out a bullish report here, but sell into it because I don't believe this. And so, you know, it was the pump and circumstance that you often see, that really, if they told you the truth, they wouldn't get underwriting business. There's a lot of things, the conflicts of interest that are there. And, you know, one of the reasons I kind of left the banking world and kind of gone the independent route was to make a real difference. And that's not making a good market call or bad market call. I'm saying to set a business up so that you know, you can be free of that conflict. You can actually guide your portfolios and protect for clients when you really think you need to do that, versus being stuck in a box.
That's honorable. So what you just described is something that Jeremy Grantham of GMO calls the commercial imperative of forecasting and of the industry in general, is that it always has to be positive because it pays to be positive. You know, I have people that I talk to that say, you know, it's funny, but the bears never seem to gather any assets. If you want to gather assets, it's important that you be bullish. Otherwise, why would anybody give you the money? So that's bullshit part. Now let's do the second half here, and that's shift happens. If it was up to you, if Larry Berman could wave a magic wand, what would you do to overcome the problem that you just identified a moment ago?
So I think part of why it happens, it's the regulation. It's, you know, what you can say. It's client education. I think, and why I spend a lot of time on BNN, not giving tips. Right. You know, I often say when I'm in front of an audience, put your hand up if you're here to get a tip on a stock. And the people that put their hand up, I say, okay, get out. Here. Well, I want to teach you how to fish, not give you a fish. Right. So I think a lot more effort needs to go into educating investors, far more than there is now from the street. There's a lot that does get done, but it gets done in the context of trying to sell something. Right. And I think it would be better if there was that was better. But let's go back one step. We don't teach kids in school how to balance a checkbook. Like, there's not enough practical stuff in the education system today to arm kids for the future that, you know, and so I think education is probably, you know, investing in education is really something that can go a long way to help a lot of that. And that's why I do the educational segment and spend so much time on it. And I couldn't emphasize that enough. You know, do your homework. Don't take the tip. Understand why you're making that decision and avoid some of those behavioral challenges.
I think we're very much cut from the same cloth. Larry, it's been a real pleasure. Thank you so much for coming on. Larry Berman of BNN Market Call, and a longtime industry veteran and a real resource and a real shining light in the financial services industry in Canada. Thank you so much for coming on, and we will see you soon.
Thanks very much, John. Pleasure.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.